Economic recessions can be unsettling for investors, but gold has historically played a role as a potential portfolio shield during these periods. As we begin 2026 with the possibility of an economic slowdown on the horizon, let's explore how gold tends to perform during recessions and whether it can offer downside protection. What happens to gold during recessions? It's important to understand that gold's performance during recessions is not always consistent, but there are several key factors that often drive demand for gold during economic downturns. Safe haven. Demand. During recessions, investors often become risk-averse and seek safe haven assets to protect their capital. Gold is often seen as a safe haven due to its intrinsic value and its history of maintaining its value during times of economic uncertainty. As stock markets decline and corporate earnings weaken, investors may allocate a portion of their portfolios to gold as a defensive measure. Lower interest rates. Central banks typically respond to recessions by lowering interest rates to stimulate economic activity. Lower interest rates can make bonds less attractive, potentially increasing the appeal of gold as an alternative investment. Lower interest rates also reduce the opportunity cost of holding gold, which doesn't pay any interest. Inflation or fear of inflation. While recessions can sometimes lead to deflation, they can also be accompanied by concerns about future inflation. Governments may implement stimulus measures to combat recessions, which can increase the money supply and potentially lead to inflation. Gold is often seen as a hedge against inflation, so investors may buy gold during recessions as a way to protect their portfolios from the eroding value of fiat currencies. Currency debasement. During recessions, governments may engage in currency debasement to boost exports and stimulate economic growth. This can weaken the value of their currencies and increase demand for gold as a store of value. Increased uncertainty and volatility. Recessions are often characterized by increased uncertainty and volatility in financial markets. This can lead to greater demand for gold as a safe haven. Historical performance. Some examples. The 1970s. Stagflation. Gold performed exceptionally well during the stagflation of the 1970s, rising sharply as inflation soared and the economy struggled. The dot-com bubble burst, 2000 to 2002. Gold rose modestly during the dot-com bubble burst, providing some downside protection to portfolios. The global financial crisis, 2008 to 2009. Gold initially declined during the early stages of the financial crisis, as investors sold off all assets to raise cash. However, it subsequently rebounded strongly as the crisis deepened and investors sought safe haven assets. Early 2020 recession. Gold saw strong performance as a safe haven asset. Is a recession looming, or is the economy growing? What are the key economic risks and uncertainties? What is the level of investor confidence? Investors should consider their existing portfolio allocation. Does your portfolio have sufficient diversification? Is your exposure to equities too high given the current economic outlook? Their risk tolerance. Are you comfortable with the potential volatility of gold? Their investment goals. Are you seeking short-term gains or long-term protection? Potential downsides of gold. During recessions, it's important to acknowledge that gold is not a guaranteed shield during recessions. There are scenarios where gold may not perform well. Liquidity crises. During a severe liquidity crisis, investors may sell off all assets, including gold, to raise cash. Deflationary environments. In a deflationary environment, the real return on cash and bonds may be higher than the return on gold, making gold less attractive. Strong dollar. A strong US dollar can put downward pressure on gold prices, even during a recession. Sophisticated investors typically view gold as a long-term strategic asset rather than a short-term tactical trade. They may increase their gold allocation during times of economic uncertainty, but they also rebalance their portfolios regularly to maintain their target asset allocation. They consider a variety of factors, including inflation expectations, interest rates, geopolitical risks, and currency movements when making decisions about their gold allocations. As of January 2026, given the current economic outlook, A moderate allocation to gold, for example 5 to 15% of a diversified portfolio, may be a prudent strategy for investors seeking downside protection during a potential recession. However, it's essential to tailor your allocation to your specific circumstances and consult with a financial advisor. Want to deepen your understanding of gold's role during economic downturns? We provide practical insights to help you navigate economic uncertainty with confidence.